Hi students, welcome to the video on management accounting. The most vital chapter, that is ratio analysis or financial ratios. It is very important for all commerce students, bankers, even businessmen. So this is my video number 1. So ratio is a mathematical number that measures the relationship between two accounting figures. It is also called as financial ratio. It can be expressed as fraction proportion or percentage in between two accounting figures. Fractions mean, suppose you want to compare the current asset with current liability. Suppose you get the ratio 3:1. That is in fraction, that is 3/4, 1/4. If it is in percentage, means gross profit ratio, that means gross profit divided by net sales into 100, that is in percentage. So the use of different types of accounting ratio to evaluate the financial performance of the business is called ratio analysis. So what is the purpose of ratio analysis or financial statement? So it helps us or help the business to compare or have a comparative analysis of profitability, liquidity and solvency of the business. Whether the business is earning or the company is earning profit or loss, or it is in a liquid position, that means it can repay within a short period of time, and there is solvency, maybe short-term solvency or long-term solvency. Again, it is also essential to know changes occurring in the business. In this case, we will compare the previous financial data with current year financial data. Then we can assess how much changes in each either assets or liability. It helps us to understand the operating, investing and financial decisions. So it is helpful for intra-firm comparison, means inside the business there is comparison. We will compare the previous year figure or previous year data with current year data inside our organization. Inter-firm comparison means among the business and similar type of trade. Then classification of ratio. Ratios are classified under two heads. One is traditional classification and second is functional classification. In case of traditional classification, we may consider on the basis of, that is, balance sheet ratios, profit and loss ratios and composite ratio. In case of balance sheet ratios, both the items are taken from the balance sheet only. In case of profit and loss ratio, it will be taken from the profit loss, that is trading profit loss. Suppose in case of balance sheet ratio, we will compare the current asset with current liability, then it is within the balance sheet. If we calculate the net profit ratio, gross profit ratio, we will compare the net profit and sales which is inside the profit and loss statement. Then composite means one data from balance sheet, another figure from profit loss. Then functional classification. On the basis of function, we can classify it as liquidity ratio, that is analysis of short-term financial position of any business concern. Solvency or leverage ratio, that means analysis of long-term financial position of a business. Then activity or efficiency ratio, that is asset management ratio. Then profitability ratios and coverage ratios. Then we will focus first on liquidity ratio. It may be current assets and current liability, that is current ratio, or liquid ratio, or absolute liquidity ratio. First, in current assets, current ratio, it is the ratio of current assets and current liability. So, you know, current asset includes cash and other assets which are convertible or meant to be converted to cash during the operating cycle of the business. Operating cycle of the business means generally suppose in 1 year, one trade cycle is there. First, we will invest cash, we will purchase the raw material, we will convert the raw material into finished product, then we will sell the finished product to the customer. It may be sold on the basis of cash or on credit. Then if it is on credit, then sundry debtors or bills receivable will arise. Then again within a short period, suppose we have given 2 months period to our sundry debtors and we will collect within 2 months, then our operating cycle is complete. So current asset includes cash and other assets which are convertible or meant to be converted to cash during the operating cycle of the business. Current liabilities means liability payable within a year's time, either out of existing current asset or by creating of new current liabilities. And remember, book debts means when we are selling goods on credit basis or our stock should not be more than 6 months, and also loose tool should not be more than 6 months. If it is more than 6 months, we will not take it into account or consider it under current assets. So here one problem is given, we have to calculate the liquidity ratios. So first is current ratio. So current ratio is current asset by current liabilities. Here one balance sheet is given and the balance sheet is in vertical form according to Companies Act 2013. Then first it is given, following is the balance sheet of X and company as at 31st March 2023. So first equity and liability, shareholder funds, first equity share capital of rupees 10 is 5 lakh, reserve and surplus, the reserve 50,000, profit and loss balance 50,000, non-current liability 5% debenture 3 lakh, bank loan, this is long-term loan or non-current liability 2,50,000. Under current liability comes sundry creditors 75,000, bills payable 50,000, outstanding expenses 5,000. So our total comes to 12,80,000. Then under assets, non-current assets, that is property, plant and equipment, and also intangible assets is not in the question. So intangible asset, land and building 4,50,000, plant and machinery 2,50,000, current assets, cash in hand 25,000, cash at bank 55,000, marketable securities 2 lakh. Then under trade receivable, sundry debtor is 85,000, bills receivable is 1,05,000, inventory is 1 lakh, prepaid expenses 10,000. So we have to calculate the ratio. So current ratio is equal to current asset by current liability. Under current assets comes, suppose we will write here, that is 100 hectares 2,50,000. Then here so under current assets that comes cash in hand 25,000 plus cash at bank 55,000 plus marketable securities 2 lakhs. Then under trade receivable, sundry debtors 85,000. Then bills receivable 1,05,000. Then inventory is 1 lakh plus prepaid expenses 10,000. So it comes 000 10 5 15 5 20 then 2 4 9 9 17 17 1 18 then 1 3 4 5. So 5,80,000 is current asset. Then current liability is sundry creditor 2,75,000. Then bills payable 1,50,000. Then outstanding expenses 5,000. So it is 4,30,000. So here current asset is 5,80,000 divided by 4,30,000. It is approximately suppose for 1.4. But as per the golden rules or rule of thumbs, the current ratio should be 2:1. But it depends on the nature of industry. In banking, generally we are considering 1.33 ratio is manageable. Then that one is liquidity ratio, then liquidity ratio or solvency ratio. Liquidity ratio or solvency ratio. Here we will compare the current asset with or liquid asset with current liability. Liquid asset. Liquid asset means the assets like inventory and prepaid expenses will not be taken into account in case of liquid assets. So we will deduct 1,10,000 from this. So when we will deduct 1,10,000, it will be 4,70,000 by 4,30,000. The ideal ratio is 1:1. So here also it is 1:, that is 1.1:1. So it is correct. Or we can consider that this company is having liquidity. Then absolute liquid ratio. Absolute liquid ratio means it includes only cash in hand, cash at bank. So cash in hand is 25,000, cash at bank 55,000 plus marketable security 2 lakhs. So it is 2,80,000. So 2,80,000 means here the asset is 2,80,000 and liability is 4,30,000. And ideal ratio is 0.5:1. That means current assets, that is absolute assets, current assets which includes cash in hand, cash at bank and marketable security should be half of current liability. Here it is more than half, that is 0.6, that is 0.6:1. So this ratio, this industry, the ratio is, in current ratio, the ideal ratio is 2:1, but in this problem it is 1:4. Then 1.4:1, that is it should be 2:1. Then liquid ratio is 1:1, it is also applicable here or in this industry. Both it fulfills the liquid ratio or solvency ratio and absolute liquid ratio are the ratio of cash in hand, cash at bank and marketable security divided by current liability. So you should know what is gross working capital. Gross working capital is equivalent to current asset, that is gross working capital, only current assets. Then net working capital means current asset minus current liability. Suppose it is net working capital, then we will do current asset minus current liability. Thank you for watching this video, and if you like this video, you should share and subscribe for it. In the next video, we will discuss some other problems of financial ratio analysis.